Interest rates are higher than they've been in decades, and while that's bad news for borrowers, could be good news for savers. Our financial expert Paul Hood with Hood CPAs joins us with what that means for those looking to make a little more from their savings. Paul, good to see you.
Good to see you.
So according to the FDIC, the standard savings account earns 0.46% on average, but there are other types of accounts where you can learn a lot more. So Tatum and Stacia give me a hard time because I started a high yield savings account recently, and I'm all excited about it because I love looking every month and seeing, wow, I made this much money by doing nothing. It just sits here, you know. Yeah. And so first off, for those that don't know, just explain what a high yield savings account is.
So it's kind of in between a CD and just a passbook savings account or a money market. It all ties into what kind of limitations there are for withdrawals, minimum deposits, maximum amounts are in there, and they tend to pay somewhere in between, and sometimes even a little better than CDs.
Yeah, and so if you're interested in this, I know American Express has them, Capital One. There's a lot of different online banks that do it, and also other banks as well, is that right?
Yeah. I mean, you can go to your bank, you can go to a credit union. Credit union seems to be actually outperforming some of the banks with some of these high yield savings accounts. The ones that are online tend to be a little bit more, but oftentimes they limit what you can put into them. Most of them you can have a maximum of, say, 4 withdrawals a year. So it's not like a CD, you tie it up for 6 months or 9 months or a year. It's tied up, sort of, but you can pull money out multiple times a year. And it's just straight interest.
Yeah, let's talk about certificates of deposits, too. What is that, and is that a good idea for some people?
So, yeah, CDs are great. They tend to pay a little higher interest rate than even a high-yield savings account. But you tie them up. And one of the downsides with a CD is, let's say we put $50,000 in a 6-month CD and tomorrow you need $5,000. Most CDs, you have to pay the penalty on the full $50,000 even just to get a little bit. So what you have to be careful is how long you tie it up. Now, you can layer CDs. A lot of people will layer them. Well, they'll do some, 3 months, some 6 months, some 9 months. The challenge, though, is if interest rates go up and you're locked into a 6-month, then you lose out on that.
Yeah. What's your message to somebody that's maybe looking to save some money right now? I mean, there are a lot of options out there. I've heard, too, that, index funds, like a Vanguard or something, you can actually make more on your return. So what's the message to somebody that's looking to save? I mean, there's a lot of options out there.
Yeah, so the message would be the shorter your time horizon, the more you need to go to some of the passbook savings or high-yield savings accounts or even a CD. The longer your horizon, an index fund typically will outperform if you do what's called dollar cost averaging, meaning you put in money every single month and versus dropping a lump sum in. Because if you put money in and this month the market's high, yay. If the market's low, double yay, because you're buying things on sale, and so it lowers your average cost basis, which makes it better for you to make money. But the longer your horizon, the more you should tend to or trend towards equities.
All right, Paul, thanks so much. Great advice. We appreciate it.
Appreciate you.
We'll be right back after